All right, we're going to get started today by looking at the S&P 500 like we usually do. We are within a couple percent of the all-time high of the S&P 500 now. You can see that we had a V-shaped recovery in the past month or so, and we're above all of the moving averages in the S&P. So we do have momentum, but we are overbought. If we look at our stochastics, you can see that we are at a 98. This is as high as you can get. Um, So it's most of the charts that we're following are ripe for a correction or a pullback. So you can see, let's look at the trend lines for each of the sectors and stocks we're following. You can see that almost every stock we're following an index is overbought and at the top end of their range. Um, so you can see overbought, overbought, overbought. That doesn't mean it can be more overbought, but whenever you're in the process of accumulating stocks, you want to buy when everyone else is selling, like right here. And whenever the stock market is overbought, you either sell some or you don't buy. So let's look at our talking points for today. Okay, we're right in the middle of April. We have earnings season just starting right now. So we have banks starting the earnings. Um, Banks usually report the first in the quarter, and then we have some of the tech stocks come later on, about a month later. So the great thing is, once earnings season's over, which it was right around the end of March here, we had some earnings reports. Now we're starting the second quarter reporting, so that's pretty exciting. Okay, so let's look at what the earnings reports from this last week. There weren't a whole lot because it was the end of the last quarter's earnings. But this week we're seeing Citibank, a lot of the big banks reporting. We had Goldman Sachs and we had Wells Fargo on Tuesday. We have Bank of America on Wednesday. TSMC, this is the main manufacturer of chips for NVIDIA, Apple, a lot of the big tech companies. We have Netflix reporting on Thursday. So a lot of banks, and um, that'll give us a hint of how the consumer is doing. Everyone looks at the banks for a good understanding of consumer trends and whether people are buying or holding back on big purchases. Okay, let's look at we've had a big recovery in the S&P. It's up 6% since last week. We have um we have only 29% of the S&P above the 50-day, 42% above the 200-day. Um we have we have we're above all the moving averages, so that helps a lot for momentum. Um we have the 10-year up 7%. Wait, that's not right. Let's look. You see the 10-year has been going down, the 10-year yield. And it's an inverse correlation to the S&P 500, which has been going up. So a lot of this movement in the 10-year in the stock market has to do with the happenings of the war in Iraq. And recently this week, we had some indications that we were having some talks with Iran, and the talks fell through at the beginning of the week. And um, every day there's a different news story that's tugging the price of oil down or up. So the market is basically following the formula that we laid out before, which is high price of oil. Let's look at or wait, here it is. War with Iraq. Price of oil goes up. That's inflationary. Consumers will have less to spend on goods that are increasing in price. The uncertainty with oil supply, with the Strait of Hormuz being closed, that is when there's inflation, that means that the Fed is not going to cut interest rates and they'll probably raise them. So that is not good for the stock market. Um, so every day we have either a risk on or risk off in the market based on how the news is in Iraq. That's basically the daily gyrations that are happening. So we either have risk on, which means all the things that are pretty risky and are high growth that are sensitive to interest rates going down, they do well. When the risk off, um, the very conservative dividend paying stocks um, basically go opposite ways. So, all right, so let's go back to the beginning here and start looking at, okay, seasonality. Now that the stock market is kind of back to normal after that little excursion with Iraq War, um, we can concentrate on the seasonality. You can see that April is the best month of the year. So we do expect good things out of April. And we have a very low volatility in April. So um, let's keep that in mind. And let's look at the S&P 500 chart. You can see that we're in like a trading range right now. It's kind of sideways for the past, since October, 6 months. So we're at the top of that range right now. So we'll either break out of that range or basically go sideways throughout summer and until we have earnings that propel us out of this range. You can see that we're overbought. So the short range S&P short range oscillator. This is one of Jim Cramer's favorite um, tools. Is 3.19. That is overbought. So that matches our overbought signal on our stochastics. So our translation is sell or it's a caution signal. An S&P short range oscillator value above 5, we're at 3 right now, above 5 or exceeding 8 plus 8 suggests that the market is overextended to the upside and due for a pullback. So that is it is not a good time to start accumulating stocks when everyone else is buying. That is the translation. Let's see. Okay, we've already talked about this, our formula. So right now, our formula is the price of oil is decreasing. It went down a lot recently due to progress with the war. So inflation decreases, the chance of rate cuts go up. Stock market likes rate cuts. Um, Recession chances go down, and we are switching from a downtrend to an uptrend. Okay, so that is the formula this week. And we noticed that the U.S. Treasury, of course, is going down. This is going to help a lot of the companies that are borrowing money, and it's going to hurt the people that are trying to have a good yield on their investments. So let's look at some of the variables in our stock market. We have the price of oil is down to $96 a barrel. That's down 5% since last week. So the war in Iraq is causing the price of oil to fluctuate a lot. And that is totally affecting inflation because we had a high inflation reading recently. Um, so we had a dollar index that was down 2%. So that's going to help a lot of the multinational companies that do a lot of business overseas. We have gold down 2% since last week. So usually a stronger dollar tends to drive gold prices lower, but right now a weaker dollar and the gold goes down with the weaker dollar. So there's no correlation this week. Let's look at The dollar index is kind of in a sideways pattern. We're at the top end of the range, so we can assume that the dollar is going to weaken in the near term down to here, and we're going to follow this pattern. The fear and greed index. We were at extreme fear 2 weeks ago. We're moving steadily to a neutral to a greedy state. So our translation for fear is start looking for things to buy. We have to do the opposite of what the rest of the market is doing. Okay, so we have an amateur investor survey, more bears than bulls. So the translation is start looking for something to buy or don't sell. The VIX has totally gone down a lot. It's down to 19 right now. So we translate that into a bull market, and people are starting to get excited about investing again without buying protection. Um, you can see how low this is compared to the last year. It's about the average it's been for the last year, the high end of the average. Okay, right now we were in extreme fear last week. Now we're at fear in our emotional graph, and we're kind of returning to normal. And any correction is kind of we have denials. People don't believe that there is a correction, and um, let's see what problems we have right now. We still have tariff problems. We still have an unresolved war situation with the United States spending a lot of money. And okay, all right, let's look at our first to worst. The best performing sectors last year are some of the worst of this year. You can see IT is still down this year, down 2%. Last year it was up 30%. So right now the best performing sector is energy, 27%. That was one of the worst performing sectors last year. It was only up 2%, only up 4% last year. So this indeed went from worst to first. Um, what else can we see from this? We have some pretty conservative sectors doing well this year. We have utilities, materials, energy, consumer staples. These sectors pay dividends, and usually a they are sectors that people go to whenever they need when they're afraid the market's going to go down or they need some kind of safety. So we are um, we are about halfway, no, 1/3 of the way through the year, and it seems like the United States wants to end this war in some way. So we'll see if that helps the stock market at all. Right now, let's look at the sector PE valuations relative to history. You can see financials are the most undervalued sector of the stock market. I thought it'd be interesting to go through a couple financials this week. Right now, the financials, as we can see, are some of the worst performing sector. It's one of the worst performing sectors of the year. Actually, it's the worst. So, as a contrary, whenever you're investing, you have to think contrary. And um, whenever we're putting together a portfolio, we're trying to be diversified. So you have large caps and mid caps and real estate, small cap, individual, diversified. You have some international, fixed income. So right now, this would be a good time to start looking at some financials because they're out of favor. Everyone's selling them. And we have a catalyst of earnings season this week of the banks reporting their earnings. We do have a potential issue with private credit. It could be a problem that takes down a lot of the smaller banks or smaller lenders. We don't know. That's like an unknown. But JP Morgan's smart enough to not lend, um, major amounts to bad lenders. So right now, financials are a good sector to look into. Healthcare is another. It's been unloved for like 4 years now, and I'm not saying it's due, but I'm casually looking in the healthcare sector for some stocks to buy. Um, what else here? IT is actually, you can see that it at the beginning of this year, it was at a percentile of 96. Now it's at 43. So it's actually becoming a little bit more reasonable in price. So that's why we like to look at IT right now for possible babies thrown out with the bathwater. We'll go over some IT names later on today. Okay, so you can see that energy is the best this year. Materials, industrials, utilities, real estate, and consumer staples. Let's look at some of the stocks going up and down today. Okay, so we can see Oracle is the top performer for the S&P 500. We had SanDisk. This is one of the memory providers for the AI trade. You can see that it was actually added to the NASDAQ 100 index. So there's a lot of people that are going to have to buy that if they're going to mirror the NASDAQ 100. And look at this, ServiceNow. We're going to go over ServiceNow. What we see here is um, we see some software companies being bid up. We're going to go over ServiceNow and another software company a little bit later because a lot of the software companies have been sold off because of AI possibly making their software worthless and reducing the headcount. So if you have less people using your product, you lose headcount and you don't make as much money and you stop growing. So we're going to look at ServiceNow and um, Oracle is actually a stock that's super out of favor. Let's look at Oracle, the chart. Oracle is an example of a stock in the software sector. The software sector has been crushed. Look at this performance from the beginning of the year. Um, Oracle was 330. Now it's 156. That's half off. But they're still kind of expensive. If we look at, let's see, I like to look at Yahoo Finance for a quick understanding of statistics for a company. So let's look at Oracle. You can see that their PEG ratio is 1. That means they're fairly valued. They have gone down and they basically are half priced, not half priced, but they're half the price that they were a year ago. So it seems like they must be growing at 20% and their forward PE is 20. So a lot of times whenever you have quality companies that sell off, they they tend to sell off until their PEG ratio reaches 1. And whenever it reaches 1, then there's a bid on it. And that happens a lot with the larger the company. And okay, so let's look at let's look at more of the stocks that are going up and down. Fidelity National Information. This is an example of a software-based company, FactSet Research software. A lot of these companies that are financial software companies, they got sold off because AI might replicate what they do. Accenture, again, they do consulting for software. Um, and if AI might take away some of their sales. All right, Carvana. This stock has been in our stock screen every week for the past couple months. Let's look at top decliners. What's the theme here? We have some conservative stocks that pay dividends. PG&E, utilities. We have AT&T. They pay a dividend, a high dividend. They're a telephone company. So what's going down? Conagra Bank. These are dividend paying stocks that are conservative. So it's a risk on, risk off. Right now it's a risk on day for the stock market. All right, that was good exercise. Now let's review the 10-year. The 10-year has been going down. And our translation is 10 yields of the 10-year going down. That's positive for technology, for small cap stocks, any company needing to borrow money. And that's positive for high yielding stocks. Let's see if that's what happened in our sectors. We see technology benefited. Technology likes to borrow money to grow. So the less it costs to borrow, that helps them. So let's see, financial, biotech, they borrow the most amount of money because they are not profitable, the biotechs. So so far it fits so far. So prices of the 10-year going down helps home construction because that makes mortgages more affordable. So that makes sense why home construction will be going up. Let's look at the sectors going down the most. Utilities. Hmm. You'd think that utilities would do well because if the yield of the 10-year goes down, the demand for high yielding investments go up. Staples, again, the same the staples pay a dividend, so you'd think that lower interest rates um, would help there be demand for high yielding investments. Okay, so gold, energy, gold stocks and energy stocks go up or down based on the price of the underlying commodity. So we're going to skip over that. Okay, that was a good exercise. Let's go back to our talking points. Um, let's look at the analysis picks from the beginning of there. This impinge was a loser, 39% down. Nike, this was just as big a loser. So we've been following Nike for a while, and Nike is just an expensive stock. If we let's look at Nike, and we'll look at their fundamentals too, just for kicks. Rats. My guess is it still has a high peg ratio. It's still overvalued. Let's look. Peg ratio. Oh, it's decent now. It's 1.33, so it's 33% overvalued right now. Its 4P is 22. That's around what the market is trading at right now. So I'm still not interested in this because there's too much competition in this industry right now. And Nike made a bad decision of pulling their shoes out of Foot Locker and a lot of retail stores, and that's what allowed O&N and a lot of other shoe manufacturers to take some market share. So let's look at okay, Nike. Yeah, that was a loser pick. Apple is down 5%. Boeing is flat for the year, and Cisco is up 7%. All right, so we'll keep following his picks. Um, okay, so in this environment, we have a lot of volatility. Um, a game plan to deal with this volatility, dollar cost in the high growth stocks that are in the top 10 of mutual funds that are out of favor. Look for companies with high free cash flow, low debt, growing 10% or more per year. Buy small amounts of quality companies as they sell off, and look for stocks selling at a low PEG ratio, safe from disruption. That is tricky because there's a lot of companies being disrupted. Um, Rotate into undervalued sectors relative to history. Like right now, we could rotate into some financials. If you don't have any financials in your portfolio. Okay. Okay, we already went over that. Here's some interesting charts. Um, Look at this chart from Microsoft. We have a double bottom going way back 1 year. And Microsoft has been sold off with a lot of the software stocks, but Microsoft isn't just a software stock. And a lot of what they sell for software is hard to replicate. They have a moat for their office and they have a growing cloud business. And they have a lot of different types of businesses. They have Xbox, they have cybersecurity, they have, of course, Office and Windows. They have, they're getting into a lot of different, and of course, the cloud is their biggest grower. So for me, I bought this in 2010. You know, it's for me, it's like a stock that grows like 10, 15% a year on a regular basis. And it's one you can buy and hold. And right now it's down a lot. And we have a good level of support right here, where we were at last year at this time. And we're oversold. Look at that. Okay, so let's look at another one. Let's look at NVIDIA. Look how it's going sideways, at least for the last year. We're at the top end of the range right now, and we're overbought. But in 1 month or so, we're going to have earnings. And if we have really good earnings, then it'll break out of this sideways pattern. And this is there's a saying, um, the longer the base, the higher in space. Louise Yamana said that. So this is an example of a basing pattern right now. It's basing. And we get a little bit of good news and it breaks out of that. Until then, we can expect NVIDIA to go back down here and up here in the zigzag pattern. Let's look at MasterCard. This is very similar to Microsoft. Last year at this time, we were at that same level. And you can see that all financials are going down in a downward pattern like this. But for me, this is a stock that's growing like 20% a year on a regular basis. And I've held this. This is one of my longest holding, along with Visa, um, because they're growing on a regular basis. They don't have a whole lot of exposure to credit problems because they're just a toll collector. They take a portion of every transaction and they don't have to deal with people not paying their credit cards. But in this case, they're down with all the financials because they're classified as a financial. They are kind of at risk if the economy is really bad. People don't spend as much money, so they don't make as much money in that sense. But they're growing right now and they're investing into different categories, new technologies. So um, it's an interesting one. Let's look at MasterCard's numbers. They're growing at 16% and their PE ratio, forward PE is 25, so their PEG ratio is 1.5. You can see their profit margin, all these numbers are like off the charts. Good. That's like 2 or 3 times what we're looking for profit and profit margin, and return on equity is 10 times what we're looking for. They have about 9 billion in debt, and 9 billion out of 444 billion is a drop in the bucket, so it's not a problem. And they're very profitable. They make 16 billion in free cash flow. So they're growing at 16%. PE ratio is 25, so their PEG ratio is 1.5. So that's 25, the PE ratio divided by the growth rate. So it's around 50% overvalued right now. Okay, let's look at our stock screen for this week. You can see that some of the ones I'm impressed with, Micron, of course, they're like a 0.12 PEG ratio. That's like the lowest in the whole stock market for large caps companies. And Oracle is actually showing up in our top stocks too. You can see that it has a maybe 20%. It's very close to their fair value, which I mean, they're about fairly valued right now, Oracle. So I'm not too keen on Oracle. It's still a little bit expensive, so I wouldn't jump into buying that. And it has a problem where all the software stocks are selling off, so you might continue going down with that sector. GE Vernova, of course, they're on 20% off according to their PEG ratio. It's zero point 0.8. Marvell Technology, they have a PEG ratio of 1, which is pretty fairly valued. Um, and you can see Netflix is on this list, but it's a little bit, it's like 80% overvalued right now compared to their growth rate. Um, I see a lot of banks in this screen. Half this half of the stocks in the top 20 of big companies in our screen are banks because they're pretty much out of favor, so they screen well. All right, here's a story from Morningstar. Five-star stocks this week. And they mentioned ServiceNow and Viva systems are now seen as significantly undervalued. Okay, ServiceNow and Viva systems, they do software for AI data centers. So both of them are in the same kind of group, and their stock charts look exactly the same. This is an example of what's called catching a falling knife. The software sector has been crushed this year, as you saw with Oracle. Um, okay, so Morningstar likes these five stocks. I thought we'd pick two of them and go over the financials on two of them. Let's look at ServiceNow. They are a company that provides virtual um, environments for development and for companies to use computers. And they actually handle a lot of the IT related chores of major corporations. For instance, they would set up your computer, they would change your password if you lost it, and so and if you have an issue with hardware, they would be in charge of fixing it. So that is that software as a service is like a super out of favor right now, but you can see in our top performing stocks today. Let's look at that again. Market movers. We see a good portion of software as a service in this top performers. So we could see that sector coming back into favor. I don't know. Until we break out of this level right there, you can see we're in a zigzag, zigzag. If we break out of this level and all these stocks, then there's a good chance we might get out of this. But right now, the underlying trend is down. Look at that. It's a horrible chart. Um, but because Morningstar said to look at it, we're looking at it. You can see that their growth is 20%, their earnings growth, if we look out a couple years. So it's pretty consistently 20%. And their PE is 20. So this is another example of a stock that is trading down to its PEG ratio of 1. And right now its PEG ratio is 1. That means it's growing at 20% and their forward PE is 20. So it's about fairly valued now. But and you can see the numbers are right what we're looking for return on equity and margin, profit margin. One big problem with this is they could be disrupted, and we don't know if AI is going to take over a lot of what they sell. Is there a way for AI to manage a data center? I don't think so. But right now they're trading down to what their fair value is, it seems. But you take the added risk of that downtrend continuing. That's called catching a falling knife. When a stock is falling, 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 when does it start going up? Well, I rely on this chart whenever it breaks out of this downtrend right there. If it starts going here and here, then you know at least you have a break of this downtrend. But this one's not for me because there's not a margin of safety. If it was half off, if this peg, if the PE, um, if the peg ratio was zero point 0.5 or something like that, I would maybe start buying just a small little bit of it and hope it goes down. But right now, there's not a margin of safety. If you buy it now, then it's fairly valued. If it goes down, then that's why that's why I kind of avoid these. Let's look at another one we can avoid. It's called Viva Systems. You can see it's in a very similar chart pattern. Um, Lower highs, lower lows, and it's oversold. But you can see the numbers. Its forward PE is 17, and it's growing about 11. So if it's growing, let's say 12, it's growing at 12%. The PE ratio is 17. That means its PEG ratio is 1.4. So that's different than what Yahoo Finance came up with. They say its PEG ratio is zero point 0.7. I didn't see that in the numbers. So you can see the return on the profit margin is double what we're looking for. Return on equity is just what we're looking for also. And six they have 6 billion in cash. So that is good too. Um, so from what I see, they are 40% overvalued. So I don't know what Morningstar was thinking. They're overvalued for my taste. There's no margin of safety right now, and they're in a decline in industry software services that's out of favor right now with no catalyst and um, other than earnings maybe coming forward. Okay, well, that was a good little exercise. Um, okay, so this is why these software stocks are going down so much. There's AI is supposedly disrupting these companies. So the software sector contagion, software stocks, including major players, have been hammered down over 20% year to date due to fears that AI agents can replicate, modify, and in some cases replace existing software and human coders. Okay, so that's why when we look at our top, um, see Accenture is an example of a stock. They're they're a bunch of they're a bunch of consultants that basically help people with integrating software, et cetera, and creating software. So if AI will take over that, there's a good chance of that sector, this stock not doing as well. So that is the tricky part of investing. You always have to watch out for competition and companies that are going to hurt your moat. And when I buy a stock, I want to buy it and hold it. And just like Warren Buffett, the ultimate hold time is forever for Warren Buffett. And when I looked at MasterCard earlier this talk, MasterCard is an example of a stock that I can see still flourishing 20 years from now. Will Viva Systems still be here 20 years from now? I don't know. They could be displaced by one app. I don't know how much of a moat they have. But the stocks that I like to own, like Microsoft and Google and Nvidia, these are stocks that are constantly innovating and adapting to change. Look how Google, they could have been taken over by AI, but they actually took the bull by the horns and developed their own AI, and um, they still have the same market shares they did before AI came around. All right, so um, let's look at one more stock, Capital One. We looked at this before. This is an example of another financial. Um, you can see by the earnings estimates, they're growing at 22% from this year to the next year. This is their earnings estimates. So if they're growing at 22%, their PE ratio is only 9. That is super low. That's like half of the market. So that means their PEG ratio is zero point 0.4. That means they're 60% off. Um, so you can see that the PEG ratio, according to Yahoo Finance, is kind of agreeing with it's actually, according to Yahoo Finance, 80% off. I don't know where they got that, but let's look at their profitability. Okay, right now the profitability is 7.8. That's not that great, but if you look at some of the other credit card providers, such as Visa and MasterCard, who have their own networks, they have a much larger profit margin, a much larger return on equity. Right now, this is probably the worst thing about this company. They have a return on equity of 2, which is not that great, and a profit margin of 7. So maybe as they integrate their new Discover acquisition, that um, they might improve these numbers. So I'll keep watching these numbers, see if they get any better. And they have about 6 billion in cash. Okay, they don't have any debt if you subtract the cash from the debt. So it looks like a pretty decent company. And if you look at let's look at their chart. You can see that we have a kind of a double bottom with this stock right now. We have the stock was at this level last year at this time, and look, it went up and it went down just as much. But you can see that the stock is starting to go above its 20-day exponential moving average, which is this yellow line. I love it whenever the yellow line turns to positive and the stock goes above that 20-day exponential moving average and it stays there. So that's a sign that we're turning from a downtrend to an uptrend. And we have some margin of safety where you know, it's on sale. Okay, that's whenever it kind of reaches that point where it breaks out of that downtrend and it's above the 20-day exponential moving average, then I start looking to buy a little bit at a time of dollar costing into that investment. Okay, let's look at another chart. We haven't looked at this in a couple weeks. Um, you can see this is the S&P 500 and Dow Jones. This is Dow Jones and it's compared against all the major issues that happened in the world. We had a tech bubble, we had Black Monday. Um, Now we have this Iran war. Um, but if you look at the big chart, every one of these things that seemed so bad at the time is just a blip on the chart. So whenever the stock market goes down a lot, just remember that there's just as many people looking to buy something as there are people selling. And as long as the earnings estimates continue to go up, there's a good chance that the stocks go up with the earnings estimates. Right now, the S&P their earnings of the S&P are expected to go up 14% from the beginning of the year. So that means most likely the stocks in the S&P will go up 14%. So let's see if that happens. That's my talk for today. I hope you enjoyed that, and I'll see you next time.